Hello, my name is Gregor Samocha, and I will be covering Hilton Worldwide Holdings Incorporated for the Finance Final Project for Hospitality 310, aka Analyzing Financial Performance. So to start, Hilton Worldwide Holdings is a huge hospitality corporation in the lodging side. It is the 254th largest corporation based off revenue in the US, and the second largest hotel chain based off of rooms in the world. So it is obviously very successful. It was started in 1919, and it has expanded significantly. It has several different brands and different appeals. So it has hotels ranging from luxury to mid-range. It also has options for resorts and timeshares. It is owned by the Blackstone Group, which owns Equity Office, which through them owns Hilton Worldwide Holdings. And then from there are several different lower tiers that own the different branches, including Doubletree, Frontenac, Ramsay's Hilton, and the Waldorf Astoria. So from there, I looked at their income statement, their balance sheet, and their cash flows from 2016 and compared them to those of 2015. Overall net sales and revenue went up from 2015 and 2016, along with the gross profit and operating expenses. However, operating income and net income before tax and net income itself went down from the prior year, and net income after tax went significantly down by about $1,000. With the balance sheet, their current assets, their total assets and liabilities also went up, and at the same time equity went down and debt went way down. So that was normally pretty good. And both assets and liabilities went up by about $1,000. So there's not a whole lot of differences there. And in the cash flow statement, cash from operating went down, and cash from investing went way down, about $800. But financing and changing cash went way up. So to figure out how they performed in the fiscal year of 2016, I did several ratios, 2 for each of the 5 categories, to determine how well they did. So for liquidity, I did their working capital ratio, where they went significantly up from 2015 by about 731, and the quick ratio, where they went 0.47 up from 2015 to 2016. For the solvency ratios, I did the debt to equity ratio, where they went up again by 0.16, and I did the solvency itself, so total assets and total liabilities ratio, where it went down by 0.01, so not a huge difference there. For the activities, I did asset turnover, and they went up by 0.01, and working capital turnover, where they went down by 111 times, roughly. So that was a huge leap from 2015 to 2016. For the profitability category, I did profit margin, where they went down by about 10% from 2015. And I did return on owner's equity, or ROE, which went down by about 20% from the last year. And then lastly, I did the operating category, where I found the ADR for the average ADR for the properties, which went up by about $2.50, and the RevPAR, the average RevPAR for the company, which went up by about $4. So that was a significant change. Overall, I think Hilton did very well, especially with RevPAR and ADR going up, because that means with ADR going up and RevPAR also going up, that means the occupancy remained consistent or went up a little bit. And I think it's in a great position due to their working capital ratio, which they can use to expand, which is needed for competing with Marriott, which is currently the number one lodging industry factor. I go on to explain that as an investor, the company performed pretty well because of how well it did with ADR and RevPAR, and increasing assets, so it has potential to keep on improving. As a manager, it also did pretty well, based off of its debt-to-equity ratio, and other ratios. There were only a few ratios that, as a manager, would be kind of unfavorable. But on the same end of that, the ones that are unfavorable for managers are favorable for creditors. And for a creditor, the company was a bit underwhelming, because again, the working capital ratio was not what a creditor is looking for, along with the debt equity, and really the solvency ratio. So overall, it would be a kind of give and take. For a creditor to make it look good, it would probably look less good for management, and vice versa, which I explained. And overall, I think the future holds a lot of promise for Hilton, as it's retained its second place spot for several years, and it will likely continue to combat Marriott for that number one spot by expanding, and it has several resources in place to do so. After that, I just have my works cited, and I have an appendix which details everything in the paper. This has been my report, and thank you for watching.